Cincinnati, Ohio, USA. About 180 years ago, in this ordinary industrial city, a candle maker and a soap maker joined hands to build a small factory. Its name was Procter Gamble. Today, Procter Gamble has become a global empire woven into the daily lives of billions of people. From detergent to diapers, toothpaste, cosmetics, and razors, this company's influence extends into nearly every household on Earth. The reason this company's name holds such power among investors can be summed up in one word: dividends. Procter & Gamble has paid dividends for 135 consecutive years and increased them for 69 straight years. For decades, it has been known as a fortress of cash flow in the volatile world of equities. But at its latest pre-market earnings announcement, a faint crack appeared on the fortress wall. The company proudly reported growth in sales and improved net income, along with an impressive return to shareholders, approximately $9 billion in dividends and $6.5 billion in share buybacks. On the surface, it sounded perfect. But hidden in the middle of that report was a single, understated line. An additional cost of about $1 billion is expected in fiscal year 2026 due to tariff pressures. That might seem like a routine disclosure, but what followed made the market pause. The company plans to raise the prices of about one-fourth of its U.S. products by a mid-single-digit percentage on average. The issue wasn't the price hike itself, but how quickly and broadly it was executed. Normally, consumer goods companies follow a careful, phased process for price adjustments, testing price sensitivity in select regions, observing competitors' responses, and expanding gradually. Procter & Gamble, however, skipped these steps and announced a full-scale increase almost immediately. This was unusual. While tariff costs had risen sharply, the urgency of this reaction hinted at something deeper, perhaps internal pressure on profit margins that had already reached a critical threshold. At this point, the company once again highlighted its core philosophy: superiority. This concept means dominating competitors across all dimensions: product quality, packaging, branding, distribution, and perceived value. During the pandemic, this approach worked brilliantly. Even when supply chains faltered and raw material prices spiked, Procter & Gamble maintained market share through trust in its brands. But today, the landscape has changed entirely. Consumers, weighed down by inflation and high interest rates, are tightening their wallets. Price has begun to outweigh brand loyalty. Large packs, coupons, and bundle deals now drive sales. In such a market, raising prices is not merely a defensive measure. It is a gamble that tests consumer loyalty itself. While household goods are often described as price inelastic, that assumption holds only for gradual adjustments. A sudden, broad price hike can break that resilience. In other words, this decision put the company's most powerful asset, brand trust, directly on the line. Around the same time, the company made another surprising announcement: a restructuring plan to cut about 7,000 non-manufacturing jobs. Typically, large corporations pursue such restructuring during downturns or after major reorganizations. But Procter & Gamble announced this while reporting rising sales. That's highly irregular. It suggests this move wasn't a reactive cost-saving measure, but a preventive step, an attempt to correct inefficiencies or hidden structural imbalances before they worsen. Yet such rapid workforce reduction carries risks. While it can reduce expenses in the short term, it may erode commercial execution strength and innovation capacity over time, especially when experienced staff in marketing and retail operations are lost. External factors are also tightening the company's equilibrium. Since 2022, when Russia invaded Ukraine, many Western consumer goods companies have withdrawn or drastically reduced operations in Russia. Procter & Gamble halted new investments and advertising there, keeping only essential health and hygiene products. However, unlike most global firms, which disclosed clear financial impacts, Procter & Gamble never quantified the effect on earnings or cash flow. That silence remains one of the enduring mysteries. Why would a company renowned for transparency suddenly fall quiet? Could it be that the real losses were deeper or more complex than they wished to reveal? This evokes memories of an earlier episode. In 2019, Procter & Gamble took an $8 billion impairment charge related to its Gillette acquisition. At the time, management cited market structure shifts and currency fluctuations, but the underlying cause was intensifying competition and declining growth in the men's shaving market. It was a reminder that even dominant brands are not immune to changing consumer behavior. And now, the current pattern of unexpected costs, vague explanations, and subtle cautionary tones feels eerily familiar. All these developments converge on one central question: cash flow. Procter & Gamble's dividends and share buybacks depend on its extraordinary ability to generate cash. Yet when tariffs, consumer behavior shifts, workforce restructuring, and geopolitical uncertainty intertwine, that cash flow equilibrium begins to tremble. In the short term, dividends will likely continue, but over the longer term, margin pressure could accumulate beneath the surface. The concern among investors is not collapse, but erosion. Small, incremental cracks forming in what once seemed unbreakable. Adding to the complexity is an upcoming leadership change. On January 1st, 2026, CEO John Mueller will transition to executive chairman, while COO Shailesh Jurikar will assume the CEO role. Normally, such succession signals stability, but the timing, amid rising tariffs, restructuring, and geopolitical tension, suggests it could mark not just a succession, but a shift in strategic direction. So the question remains: can Procter & Gamble maintain its crown as the king of dividends? Can it offset tariff-driven costs through brand power? Will restructuring boost efficiency or diminish the company's long-cultivated capabilities? And is the shrinking Russian footprint merely a temporary setback or the beginning of a long-term contraction in global sales? For generations, this company has embodied the idea of stability, yet stability often begins to falter in silence. The true mystery, investors, is not in the numbers, but in the equilibrium behind them. Even a fortress of dividends can fracture from within if its balance weakens, and whether those fractures are forming now will be revealed only by following the cash. ValueStir also welcomes your insights. If you have a listed, unlisted, or upcoming stock or cryptocurrency you want us to investigate, leave a comment below. Your tip could inspire our next deep dive analysis. This was ValueStir.